So we look at oil prices near term. A lot of people may be familiar, have seen our books before. We use Elliott wave just as kind of a language for describing patterns. It's not a set pattern. There's a lot of variations. But, we look at the oil charts and, here's our less bullish scenario that says, hey, we already peaked 5 waves up at 147. We've come down here to 40 recently. We're bouncing. We could go down as low as 18, or we could eventually retest 40 after a bounce because the economy is due to get worse later this year. But then we'll get a B wave, a bear market rally up to anywhere from $80 to $110. So if people are looking for places to make money near term after this crash, if oil goes from 40 to 80 or 110, that's a major move, much more than we're going to see in stocks. The next slide shows the most bullish scenario, that we really get a strong turnaround from this massive stimulus that's being proposed, and it's already underway. We could just go back and retest 40. There's strong support there from the first wave up, strong support at 50. So we're right now in no man's land between 40 and 50, where we're likely to hold near 40, and eventually we could see this actual $147 peak on Elliott wave actually better counts as a third wave. We got this dramatic fourth wave correction, which can happen as long as we don't break $38, wave one, and then we actually could get a new high, some $150, $170. So just imagine that. And imagine the chaos and the confusion in the economy. We go from everybody being scared to death of deflation, and next thing you know, we got inflation coming up from this recovery and massive stimulus, and oil prices at new high, and gold prices at new high. So that's just to show you how the interaction of this 29, 30-year commodity cycle and this 40-year generation cycle makes this a unique cycle, even compared to what we've been comparing it to in the past, the late 20s, the roaring 20s, and the Great Depression. That's a typical bubble boom transitioning to a bubble bust and a depression. But, hey, we didn't have a commodity cycle peak back then. It peaked in 1920 on that 29, 30-year clock. So, again, there could be some big surprises for investors and voters, politicians, and economists in this next year. Another important cycle we added to our research back in 2006 when the markets were not bubbling up as much as they did in the roaring 20s in the second tech cycle that we were expecting. We went back and looked at a theory I'd heard somebody propose once, and I thought, no. And I went back and really looked at it. I back 200 years, just like the commodity cycle, and I said, you know what? Every 16 to 18 years, cycles, the environment is good for stock market, which means low interest rates, global stability, no major wars or political tensions. And then you get periods like the early to mid-60s into the late 70s and early 80s where everything goes wrong. I mean, the Cuban Missile Crisis and presidents get assassinated and Martin Luther King gets assassinated and the Vietnam War escalates, and then on top of that the broader Cold War with Russia escalates, and inflation goes from incremental to massive, and everything. I mean, this is a cycle we find is independent of our demographic, our 40-year demographic and generational cycles. And it's helped us with the area we've had the most difficulty. We've been very, very good at predicting cycles, the direction where the economy is going to be up or not, stocks up or not, things like that, interest rates, inflation. But we've been off in magnitude in the early 2000s in the crash. We underestimated it first, and the second bull market after that, we overestimated first. So what we found is that in these off cycles, every 32, 30, 46 years, like the mid-60s, the early 80s, or like 2001, early 2000s, into about 2018 or 19, we're in currently, stocks are valued at about half of what they are in the lower risk environment. So since 9/11, we've entered another environment where we've just seen one disaster after the next, one geopolitical tension, one dictator confrontation after the next, rising oil and commodity prices, now rising inflation. Now we have a monetary crisis around the world, and we've got rising terrorism. And of course, we just saw that in Mumbai, and actually we put out a report years ago on the terrorist cycle and saw that about every 8 to 8.5 years, we see waves of terrorism. It takes them that kind of long to prepare and plot ahead, and it bothers me that this Mumbai thing was so well coordinated. That cycle peaks around late 2009, early 2010 as well, so we can expect more of this. So, we dropped our forecast in half back in 2006 with this and the commodity cycles, and now we're trying to meld all these together. And again, this is quite a complex scenario.